Well, we got a great series to cover today. Great call that we're going to do, and we will have this recorded, and so we'll share it out to people. I know a lot of people's schedules, earlier in the day can't make it, so we try and pick a good time where we can get some interaction. But really, what we're here to accomplish today is, part one was more of an interactive kind of fireside chat where we did some live Q&A, but now it's time to get into the thick of things and get into some details. And so Kevin's put together a slide deck today that we're happy to share out via a PDF, and it'll be great. We'll reserve some, we'll kind of monitor the chat throughout, and Ben and I'll chime in accordingly, but we'll more or less reserve those, towards the end of the call today. So go ahead and you can just use that chat feature or the Q&A box section. Just type that in there, and if you have to hop off early but still have a question, go ahead and put it in there. We will get to it, and you can check back later. So we hope to see you live in September in Orlando. That'll be awesome. It'll be a nice intimate group, and if you can't make it to that, then we'll hope to see you February in Anaheim, California. So that's what we have coming up. So thanks, Kevin, for taking the time and preparation to deliver the content today. And we're excited to do some learning with you.
Sounds good. All right, let me share my screen here, and we will get going. Just bear with me there we go. Perfect. Okay, that should be nice and large on your screen there. So good evening, everybody. Welcome. And again, thanks for being here, and look forward to meeting you in person in September. Some of you looking at the list I've met before, so I look forward to seeing you again. Some of you are going to be here in September, and some new folks as well. So I prepared today, as Aaron was saying, new information. I want to cover as much as I possibly can in the hour that we have with you this evening. And please, in the back of your mind, have the understanding that if you learn something from this, which I know you will, imagine what we can do with 2 days together. Imagine if we can get together and brainstorm on certain things and talk about what you can do in particular, because we will have time to socialize and everything else. And that approach to the business has always been proven to work. The closer you can work with people who are experts in the business to guide you through, the safer you're going to be, the more confident you're going to be, and as a result, the more successful that you'll be within this industry. I've been doing this for quite some time. I have a rather unique ability, I believe, to break down some complexities into simple items. So for those of you who have not seen me do a live training or a Zoom training in this type of a format, this will give you a very good taste of what the live class will be like. The only difference is in a live class, you can raise your hand at any point in time. But yes, tonight, let's get as much information your way as we can. So type those questions in. We'll get to them at the end. It's better if I go through this part because we do have to go a little quicker without stopping and starting. It'll have a nice flow to it. I've done my best to make it simple for those who are new to the business, yet also get into some advanced things for those who are more experienced in the business. So let's jump into it right here. What I'm going to cover is some fundamental information, a foundation, if you will, of where the market is and where it's likely to head. And that's important to you because all the techniques that we talk about tonight and at the event in September are going to be based upon what these market changes are. And I've been very good at this over the years, and Aaron and Ben and many of you on the call who have seen me do State of the Industry addresses know that I've got a good track record of kind of predicting where we're going to be in the marketplace. And as a result of that, I like to teach people forward thinking techniques. Now, some of the techniques, the 2 or 3 that I'll be able to cover tonight, are not brand new things that I've invented. Sometimes it's the application or the reintroduction of those techniques that's important to you. And those are the new keys to get into finding this niche, because what we get paid to do really in all aspects of this business is to solve problems. When we buy a non-performing note, we're solving a problem. Reperforming note, solving a problem. We're buying a performing note and that runs into trouble, we're solving problems. So a big part of this is that. And when you learn how to solve problems correctly, problems are really opportunities in disguise. And that's what we are looking for in this. So I'm going to start with this foundational knowledge. This is all the latest information in the industry that I can find in my research, which is one of the other things that I'm known for in the industry. This is what we were looking at several months ago. People in forbearance plans. Now, for those of you who don't know what a forbearance plan is, you probably at least have heard about it because it's been in the news for the last year. When we got into the whole COVID situation, there was a moratorium put on rent where people didn't have to pay rent. That's one thing. This is different. This is where people didn't have to pay mortgage payments. They could ask for, it would automatically be granted, or forbearance agreement. And the forbearance agreement essentially said, you don't have to make your payments now, but you will have to catch up in the future. That was the deal. It's not you don't have to make your payments and they go away. It's you don't have to pay them now, but you will have to make them up in the future. Now, that can be at the end of the loan. It can be spread out over the loan. That's a different story. Those plans were kicked down the road, and this is what we were looking at several months ago. These are the expirations, and you can see the percentage. Now, the percentage here, there was about 7 million people in forbearance. So this past March, we should have had well over 900,000 people, plus the 600,000 here with their plans to expire, 1.5 million. Nope, government decided not to do that, because why not kick the can down the road even further? So this model has moved to this. They pushed everything back. So you'll see, instead of getting a nice test market here of people coming out of this plans, meaning they have to start making their payments again, it was kicked down the road, and now we're stacked. Now we have a whole lot of people, the vast majority of people that were under forbearance, all their plans are going to expire, over the next several months. So that includes June, July, August, and September. Because they did it this way, there's no way they know what's going to happen. If they would have tested it with maybe 500,000 people, let their plans expire, and just run a percentage and say, well, it looks like a third of them won't be able to pay, or 25% won't be able to pay. The rest can do this and that. They're going into this blind because now they're all stacked up. So we have the vast majority of these stacking up here, and that's going to change the overall marketplace. We'll still have some going towards the end of the year, but you can see those start to fall off. So last month, 400,000, 600,000. So there's your million. I got another 400 there, another 500, close to 500 over here. What's happened so far? This is the latest data of all the people who are in forbearance. You can see 7.25 million. A lot of them were able to come out successfully. Their plan either expired, they were removed, and they are performing again. So almost half, 46%, the plans worked out, the people are paying again, everything's great. Perfect. That's the way it was supposed to work. You've got 333,000 in active loss mitigation. Sorry about that. You've got 195,000 that are expired and delinquent. They're not paying. Their plans have expired, but 3%, that's not a big number. You have 18% pay off their loans. Well, that's interesting. We had all this trouble. We're giving all these plans. How did they pay off their loans? Well, property values have also gone up, and they sold their house and cashed out and either decided to rent or downsize or what have you. Active forbearances, the original, under their original term, you got 221,000, and then we've got 1.836 million, which is 25% that were given the extended term. So the ones in blue here, the light blue and the dark blue, is the inventory of which a percentage is going to end up being subperforming to non-performing notes that will flow through. Not all of them, but a percentage of them. What percentage? Who knows, because of this. So I hope that makes sense to you. So it's not going to be what some people in the industry were predicting, saying we're going to have this massive amount of inventory. It's going to be a good size amount. but it's not going to be anything close to what happened back in 2008. What we're looking at here is loans in forbearance are 2 million. And by the way, you'll notice it's Fannie, Freddie, FHA, and VA, and then other non-conforming loans that are in here, and also Ginnie Mae backed loans. 2 million are still in forbearance. So that's the inventory that we'll have to see what happens to those folks. The ones who go subperforming to non-performing will end up being bundled up, sold, and then trickle down to investors like you and I. That'll cause an industry increase. It'll also create an opportunity where people need a solution. Okay? Going back to what I said in the beginning. People, we want to provide that solution. We can act quicker. We can do more things in modifying somebody's loans than the banks and the other entities are willing to do.
Kevin, how successful do you think people will be, these institutions, in doing loan mods before like they give up and it trickles down?
Yeah, they've got, the ones here are in active loss mitigation. They're delinquent. There's only 5% that banks are working with out of the full picture.
Yeah. Okay.
Yeah, so it's a smaller percentage. I mean, again, we're looking at 333,000 people that banks are working with right now. And the people they're working with are still going to have good credit. They're going to have to show that they're making income and they have equity in their property. If they don't have those three ingredients, banks are not going to take the time to work these plans out. So the people over in the blue here, if they don't start paying right away, they might get a couple letters from a bank. If they still don't pay, bank's going to be done with it. They don't have the time, the patience, the money, or really the ability to help those folks out. That creates a problem in the industry. We provide the solution.
So when I see something like that, I look at that 2 million population on the next slide, and I say, okay, let's take 5% of that now. And let's say 5% of them go into like active loss mit, when that pops, we're still back at 2 million essentially.
Yeah.
You know what I'm saying? Like, just to help people look at the context of that, like from a population pool standpoint, we're still dealing with millions.
Mm-hmm. And it will, by the way, go the way of notes and sold through portfolios, not foreclosures. It's not going to go the way of foreclosures. The government doesn't want it. These are all government-backed loans. The government doesn't want to. What administration wants to have all these foreclosures? No way they're going to let that happen. So they'll sell the notes behind the scene, let it go down to the private enterprise like us, and let us clean up the problem, which may include, we don't want it to, but it may include foreclosure. Let me prove that to you by looking at this. I know there's a ton of information here. I just want you to focus down here on the very bottom of this column here. FC starts, that's foreclosure starts nationwide. 3,761 foreclosure starts last month throughout the entire United States. That number doesn't even register. It's so small. It's absolutely ridiculous. And you can see back here in 2008 and 9, the foreclosure starts in, you can look at the dates on everything here. And we're just looking at such a low number here. We had 5,800 in January, 3,000. You can do the quick math there. Not going the way of foreclosure because, again, we've got 2-point-something million here that are not current. Okay, so this adds in the forbearance, but it also has the non-currents in here. And some of the forbearances, by the way, are not recorded in the non-current. So there's a little bit of a mix of these numbers. So that's what we're looking at. So the people who are waiting for all these foreclosures, guess what? It's not going to happen. You're on the wrong side of the real estate coin. You got to acquire those properties on the note side, because they're not going to go to foreclosure. I mean, just look at the trends. It's not going to happen there. What is going to happen is these notes that get past 90 days, that's the slippery slope in our industry. When they get past 90 days, the odds of them recovering on their own, meaning the borrower starting to make payments again, drops off the charts. 30 days, people can catch up. 60 days, got a good chance of catching up. If it goes past 90 days where someone's not able to make the payment, the odds of them catching up are slim to none. And that makes it go into a whole separate category on a bank's books. when they have too many on the bank's books, they got to get rid of them. How do they get rid of them? They're not going to do it through foreclosure. They're going to do it by packaging up the notes and selling them. It's really as simple as that. And by the way, all of this is factual data from Black Knight Financial Services. So you can see that's one of the sources that I look at on a monthly basis. But look at those percentage ratios of 90 days to foreclosure. I mean, it's pretty heavy. So we're certainly also seeing on the 30, 60, 90 days, the big increases here as well. Where are most of these loans going now? I mean, go back to 2019, 30-day lates was twice what 90 days were. Boy, that's switched now. Okay, so they're starting to pace out in this fashion. So this other wave of inventory is coming and we want to prepare for it. Now, what's different this go around is property values. Property values are going up in value, but they're also going up in price. And a lot of people, even though mortgage rates are low, choose not to because the prices are too high. They're, everybody's been around when this happened, so they don't want to buy on another peak. So some people are skeptical. It's a little bit more expensive to build right now. The inventory is really being squeezed as far as available inventory, and that's why it's going up there. What people need is affordable housing. That's still the big crisis in the United States. And that's why we focus on the space we focus on, which is the lower price band, the $150,000 properties and less. And that varies nationally, right, from where you are. So those are just some basic stats to set up why we're doing this event and why we're pointing people in this direction here. This is known data. It's got some uncertainties as to exactly what the numbers are, but we know a percentage of these folks are going to need our help, meaning they're not going to be able to make their payments and they're either going to lose their home or someone like us is going to come in and buy that note, work with the people, get the loan reperforming again, make a nice profit while also doing a nice service to keeping people in their homes. Okay, so having said that, and I want to be able to move on here with you, one of the things that you absolutely want to do, you should have been doing already, but certainly in the last quarter and into next year, you've got to focus on networking. You've got to start to think in terms of working with and building relationships with real estate investors that are creating notes. It's a great way to get going in the business. You could, with one relationship, make your entire year's worth of inventory on that. One of my clients who came from South America a couple of years ago was looking at apartments and looking at other types of real estate, bumped into the note business, found me through that, got started with me working one-on-one, and I got him into 2 notes within about 45 days. And one of the notes I told him, we're going through it on Zoom, I said, look, this person, this real estate investor here in Texas, they created this note the right way. They did, the paperwork is good, the way they qualified the people, the down payment, the way they structured the note, everything was good. And I said, you need to build a relationship with this person because they're going to do this on a regular basis because they want to focus on real estate. The problem with real estate investors in our price range, where the deals are, the affordable price range, which is where we want to be, their issue is their people can't get financing. Solution, seller financing. So they create notes, but they create notes with the intent of selling it to somebody else, not creating long-term notes. They want to cash out of the note, do what? Buy another property because that's where their expertise, that's where they choose to invest. They need a solution, which is you, to come in and buy that note. By the way, by you buying that note, that could also mean I find the note and I pass it on to Aaron and have Aaron buy it and I make a little piece of it. Okay, so I don't have to have the money, I have to have the deal. I have to have the deal, I have to have the relationship. So it's one of the things that should be on people's radar, going to real estate clubs, meeting investors, maybe even talking about investors about creative financing on there, because that will open opportunities for them. And as long as they can send you deals, you either buy them or you place them with another buyer and make a fee that way. So let me give you an example here of a deal I was just looking at yesterday. So you're the first group to see this because I literally built today's presentation on deals that I was just looking at yesterday with my clients. So I'm going to use real numbers on this one, and I'm going to parlay this one, I hope that's the right term, into something else a little bit later on here. So right yesterday, going with the client, investor paid $35,000 for a piece of property, renovated the property, Okay, so they bought it, they fixed it up, and they turned around and sold it with seller financing for $76,000. I don't know what they paid in renovation. I don't care, quite frankly, what they paid in renovation. But those were the numbers that we know and we've seen documentation of. So we saw the deed, we saw what they paid for the note, we saw what the financing was created for, and that's a part of this story. But if that's all you knew, and I came to you with this note, would this be something that you would be interested in purchasing? These are the kind of deals that investors are going to be cranking out. If you could come in and buy this $76,000 note for 50 grand, would it be a good deal? What if you could get it for 40 grand? Would it be a good deal? What if it was 60? Okay, so really it becomes a matter of price. This is inventory that's being created on a regular basis. There are now even REO companies that do this in bulk. You want to build relationships with them as well. That's the type of thing you're going to see on a regular basis. In fact, our own, I know Ben dropped off for a minute, but what do you think Ben's business model has changed to? They used to buy property and just flip the property, right? Buy it, renovate it, resell it. And then over the years, they said, no, we're going to buy it, renovate it, resell it with financing, create notes, create cash flow. And then from there, we can choose to sell a note. We can choose not to sell a note on the property. A lot of smart real estate investors have gone to that model because it works and because it fits the niche today. Okay, so with this deal, what they did, for those who are new, so I want to slow down a little bit, they sold the property, which means they created a promissory note and a security agreement. Okay, so they sold the property. To sell the property with seller financing, the borrower, the new person coming in the house, has to promise to pay it back. That's the promissory note. And the security agreement is the mortgage that says, if I don't pay it back, you can foreclose upon me. That's the agreement. Very simple. So here's the note that they created. A $45,600 note, 9.5% interest, 360 months. Payments are $383 per month. Sold the property for $76,000, created a $45,600 note. Interested? You're going to buy this note at a discount. You would be paying less than $45,000 for this note secured by a $76,000 property. Those of you who have been in the business, you already know, where did you get this deal? What you're doing? Is it still available? No, it's not available. My client's buying this note. Okay, but it's really as simple as that. Why are they buying it? It's safe. You're investing less than $45,000. Your investment's backed by a $76,000 property. In other words, if the deal went bad, you get the property back. If you're paying less than $45,000, you're making more than 9.5% interest, and you're getting less than 360 months of payments because this note's been seasoned. Okay. In other words, the borrower who's on this note has made 3 payments in this particular case. So there's 360 minus the 3 payments that have already been made. But still, imagine paying less than $45,000 to get $383 per month for the next 357 months. Not a bad deal. Because from there, we got parcels and everything else, which I'm not going to get into. So I wanted to start with a very simple example like that. It's a deal that a client of mine got. He's buying this note as we speak. Are they out there? Is the inventory like this out there? Absolutely. So I hope everybody understands that. Now, let me give you, as they say, the rest of the story. Wasn't that Paul Harvey, right? Now, here's the rest of the story. I did this on purpose and building it this way so that you can follow it. That should have been very easy for you all to follow. Simple. They bought the house, they sold it, they created this note, they're going to sell the note. Perfect. Here's what really happened behind the scenes. This is our note, or excuse me, this is the investor, going back to that same slide. But the investor who paid the $35,000, they didn't pay cash. They borrowed it. Okay, so there's an underlying lien on the property. And on the seller financing, because there's a note underlying, this note wraps around the other note, meaning the seller finance note of $76,000 wraps around the $35,000 note. So I just made it more complicated for you. Okay, so you all saw the simple example, but let me show you what again, the reality was, and this is typical, a lot of real estate investors will borrow money to buy the property. When they sell it, to sell it quick, they sell with seller financing, but sometimes if there's not a big enough down payment, they can't pay off the underlying loan. So instead they wrap it. Let me show you a different way of looking at that to help you who are new to this. So the real estate investor who paid the $35,000 owes that to a lender, some kind of a private lender. In this case, it had the last surname, so it was probably son borrowing from dad or some kind of relative. Doesn't matter. Could be any private lender out there. So the $35,000, the real estate investor owes that to the lender. They then sold this property, and now the borrower owes the real estate investor on the $71,965 note. And I'll clarify that in just a second there. So that's what is owed. So in other words, from the payments coming in on the 71.9 going to the real estate investor in turn pays their loan off on the $35,000. So obviously the income coming in on the larger amount is more than enough to pay off the lower amount. And that's how that scenario works, typically through a servicing company. The borrower pays the servicing company sends money here, sends money there to pay off the underlying loan. That is known as a wrap or wrap around mortgage. That's going to be more common in the future. Okay, it's, again, I didn't invent that technique. It's been around forever, but it is going to be more activated once again today as margins and inflation and things like that start to go into the marketplace. Now, in previous slide, I told you it was only a $45,000 note, right? So I know some people are going, wait a minute, you said it was a $45,600 note. That was to show you a simple example, but there is a $46,500 note because what they did in this case was utilize one of my techniques of doing two notes instead of one, okay? So what happens with this 71,000, that was the note after the down payment. So they sold it for 76,000. They're going to finance 71,965. Out of that financing, they still have to pay their $35,000 loan. Instead of creating one note for $71,965, they split it into two notes. They said, we'll have a first mortgage and a second mortgage. So the borrower's making two payments, one on the first mortgage, one on the second mortgage every single month. Okay. The total is still $71,965, but guess what? The first mortgage is under the terms that I told you. The $45,600 note at 9.5, 360 months for $383 a month. That's the note that they are selling. Okay. What they're keeping is this second note, which they created for $26,365 at 11.5% for 180 months, $307.99 per month. So the borrower's making two payments there, and the quick math on that is what, $690 and change per month, $691 per month. Okay, they're just sending out in two ways. Now, this was smart from the real estate investor's point of view, because they knew, hopefully, and I hope to track this person down and find out, hopefully they read my book and learned about this and said, wait a minute, if we create this $170,000 note here and we only have 3 months of payments and the house is only worth $76,000, man, we're going to take a big hit on that discount, because an investor is not going to want to be in for probably any more than a 60-65% ITV on a brand new note like this. And we would take a big discount on that. So instead, let's create two notes. Let's sell this one and keep this one. That way, they're getting a lump sum. They'll sell that note, and I'll show you this in just a minute, and get a lump sum. They'll keep the monthly cash flow every month of $307, basically $308 per month. Selling that note and structuring this deal the right way, what they're going to do with that money, of course, is they're going to pay off that underlying note. So my client is going to pay $38,681 for this note. Okay, the one they're selling over here, that's that note. They're going to buy it for $38,681. That's an 11.5% yield to the note investor at a 51% investment to value ratio, meaning that the property, he's only in it for half the value of the property, essentially. Okay, so your $38,000 investment is backed by something worth twice as much. Safe. It's making 11.5%, great yield, and they're in it for $38,000. That is enough money to pay off what? The underlying first. So the investor, the real estate investor who borrowed $35,000 to buy this property, they're going to pay that off from the sale of the first note. And by the way, you would always insist on that, that they do that, right? At some point in time, a wrap is meant to be a temporary fixture. It's a tourniquet technique, as I like to refer to it. It's not meant to be a long time thing. It's meant to, great, we got the deal done. Now let's figure out how to clear up the wrap situation. In a case like this, they structured the deal where they can sell the note enough to get enough money to pay off the underlying loan, the $35,000, and they still pocket the difference between the $35,000 and the $38,000. Okay, so they've made some money back, and now they're simply collecting on the second mortgage $307.99 every single month. And that's really a great technique for both parties here. So a couple of things on this, which is we today then have to understand that how financing works, how seller financing works, how creative financing works. When I'm laying this out for you on a PowerPoint slide, it looks easy. At the event, not going to be so easy because I'm going to show you a bunch of documents and you're going to have to go through the documents and figure all this out. Because believe me, it was like going through a layer here. When you first look at it and go, wait a minute, they still have an underlying first here. They didn't do this or that right. We had to go through the documents to get a full picture of what they did on this. So what I'm showing you here is an after result. In the real world and in class, I will show you examples where it's simple, but then we have to take that next step of, all right, now here's another one, and you guys let me walk you through this and see if you can figure it out. Since it's not that simple. So this took us about an hour or so to go through, to lay out all the documents on the screen and to put all the things together, to verify it, to check it and go, okay, this can work. You know, here's what they did. If you're brand new, I guarantee it's going to be more than an hour. Okay. We were going to public records, which we're going to do in class. I'll show you how to look up these documents. My goal with my clients, by the way, and I tell them all the time, I said, before you buy a note, for sure, sometimes before you even make an offer, you will know more about this note than the current note owner. You're going to know how to go into these deals and really put everything together. And that's the safest way to do it. The long-term investors that I've trained in the business, some of the top people in the industry, they do their due diligence and understand it. You'll have some people who, cut corners and just get lucky and buy some notes. It will catch up to you. Okay? You've got to know how to detail them. So in class, we'll be using calculators, because right here, I'm just showing you the yields and everything else. We're going to use calculators. We're going to look at live deals. We're going to look at documents. A lot of times in class, I like to get to a point where I'm looking at a live deal that you could actually buy. That'll be, it's available. And we just look through them that way. So this one had some little intricacies in it. Not all of them are that complex. A lot of them are like how I started. They simply bought a property for cash, fixed it up, sold it, and created a note. They don't have an underlying mortgage. Great, that's even easier. But if there is an underlying mortgage, there are ways to do this. I even had one where, well, I don't want to confuse you guys. We can put another technique in here called a partial, but I don't want to confuse you all on that one. But pretty cool deal. These are deals, again, available right now. This one was as of yesterday. Okay. Another trend in the industry, another problem in the industry that needs a solution. So far we know we've got to work, what I say was the first one there, build relationships with real estate investors and also brush up on our creative financing, understand how to do that, understand how to put deals together. The next problem in the industry that is likely to increase is, unfortunately, personal bankruptcies. Okay, and if you Google search that, I just took a picture of one article, but there's many articles out there that talk about this concept of personal bankruptcy rising. Bankruptcies over the last 5 years have nosedived. They've really gone down extremely low. And a part of that was, well, people's incomes were being subsidized. They didn't have to pay rent. They didn't have to pay mortgage payments, but they're getting stimulus money. So that makes for a nice combination where you don't see that level of bankruptcy. It's actually dropped below normal because we're in non-normal times, if you will. So the tracking of this now is that they're expecting bankruptcies to get back up to at least normal levels, probably higher, because again, a lot of people didn't tuck this stimulus money away. They lived off it. They haven't been paying the rents and the mortgages, but now they have to. And that's just a reality of the world here. So you're likely to see a rise in bankruptcy chapter 7 and bankruptcy chapter 13. In class, I'll go over both of those in good detail because it's necessary for you to understand that. You're going to see these scenarios. And if you're not familiar with the note business and bankruptcies, we like them. We gravitate towards them. Bankruptcy means that something has happened. And we always like when something's moving forward. What we don't like is when things are stalled in our business, where they're just sitting there. We like when things are moving forward, and bankruptcy is something that moves it forward. Tonight, I'm just going to look at bankruptcy chapter 13. Okay? Bankruptcy chapter 13 is a reorganization of debt. The goal behind the bankruptcy chapter 13 is to enable somebody to stay in their home. How can they stay in their home? Make it where they can afford the payments. Okay? Bankruptcy doesn't mean somebody has no income. Somebody could be making $50,000 a year, but their debt load got too high and they can declare bankruptcy and get relief. That's what the bankruptcy protection is. In 13, what the courts and the lawyers do on both sides is they look at the entire financial picture of that individual. And they look at secured debt and they look at unsecured debt like credit cards, those sorts of things, and secured debt like real estate. And they look at all that debt and they either eliminate that person's obligation to pay that debt or they negotiate it down when it comes to unsecured debt. So the credit cards are typically the first thing to go. They don't get paid anything, they write it off and all that sort of stuff. But the secured lenders, which is what we would be if we bought a note that had gone through the bankruptcy process, we're a secured lender. Why are we secured? Because our loan is backed by, contractually, the property. Okay, it's secured by that property. So the secured debt, like a mortgage, is negotiated under the payment plan. So let's say this. Let's say that I own the note right now and the person goes into bankruptcy. So they're seeking protection from the court to pay their debt. If they're filing chapter 13, they want to stay in their home, but they've got too much other debt. So the bankruptcy court starts to eliminate or lower all their other debt, and they would come to me as the secured lender and try to work out a deal. Now, sometimes they might come to me and say, you don't have to really do a different plan. They should be able to afford that after we eliminate this debt. Or they might come to me and say, you're going to have to try to work with us as well. Okay. If we can't make it work, well, maybe they have to go to bankruptcy chapter 7, which is a completely opposite thing here, where all of their debt obligations go away, including their mortgage, and I would end up getting the property. But on a 13, they'll probably work with a plan. Now, bankruptcy normally doesn't happen overnight. There's usually a ramp up or ramp down, depending on how you look at it, as to how they got to that point. They probably stopped paying credit cards and then they got behind on car payments, but they've been trying to pay their mortgage and now they get to the point where they can't do that. So they're in trouble. And if I own that note, yes, the courts are going to work out a plan. And the plan for the borrower is to make payments on these secured loans. the payments are going to go through a trustee. So the court's going to set up a trustee. The property owner, the borrower, is going to make payments to that trustee, and then the trustee is going to make payments to the secured lenders. All right, that's how they'll set it up. The reason they do that is to be granted this bankruptcy protection, you have to follow through on the plan. And the best way to know if they're following through in the plan is we'll send it to the court-appointed trustee. Pretty simple. If they don't live up to the plan is dismissed. They don't give you that bankruptcy protection anymore, and then all the debt owners can come right back to where they were. And by the way, I saw that on a case this morning. The person declared bankruptcy Chapter 7. They stopped making payments on the plan, and sure enough, the courts dismissed it and said, we're not going to give you bankruptcy protection. You can't have it both ways. We can't reduce your debt and help you with this and then have you not live up to the obligation. You're going to lose your property. So it's structured through that way. So the best notes to look for on the bankruptcy are the ones that have gone through that process, where maybe I owned the note, we went through the bankruptcy, and now I'm receiving payments from the trustee. If I'm selling that note, that's a good note to look at. Why? Well, when these courts look at all of the debt and they look at the secured debt, they structure a couple of plans. They go to the borrower and say, you need to make payments on this loan. So the loan may or may not have been modified. Either way, it doesn't matter. They know that this person should afford it because, well, they looked at all of their financials, right? Very, very simple. So the borrower is making a payment going forward on the loan. What they have, though, is also, it's called an arrearage account, which is all the payments, accrued interest and penalties that they've missed leading up to the bankruptcy. So if they haven't been making payments for a year and then they declare bankruptcy, there's a 12-month arrearage account there. The bankruptcy courts say you have to pay that back. On that one, what they normally do is on that arrearage account is they just chop that into payments. It's not amortized or anything like that. The loan going forward is still the amortized loan, principal, interest, etc. The arrearage account is normally set up where, okay, if you owe $60,000, we're going to divide that by 5 years, and you'll make monthly payments of whatever that is for the 60,000 bucks, right? $1,000 a month, whatever that it comes out. So they'll chop it up that way, and just it doesn't have to be 5 years, but that's normally what they do. So they'll take whatever that arrearage is and chop it up into 60 payments. So the borrower, once again, is making 2 payments. They're making one moving forward on the loan, and they're making the other one to catch up on the arrearage account. That's significant for you because when you buy these loans, you're buying on the note moving forward. But what you're getting is the note moving forward and the arrearage account. What does that look like? Okay. Note and a mortgage, $80,000 UPB. I'm rounding the numbers here. A client of mine purchased that note for $50,000. This was a reperforming note that had gone through a bankruptcy Chapter 13 scenario. Okay, so bankruptcy plan has been approved. This party's making payments on the plan. It's an $80,000 UPB. They were able to purchase that for $50,000. That alone is making a good return. But what they got with that was an arrearage account of $21,000. And they got that one for free. So now your numbers change. Now you're getting you're paying $50,000, getting payments on an $80,000 loan, making good money there. And then you're also getting $21,000 paid over whatever that scale is. Okay, maybe you're getting 10,000 of that in the first year, and 10,000 in the second, then 1,000 after that. And that really ramps your yields up there. You're going to see a lot more bankruptcies coming up. It's going to happen. Logically, the marketplace is there because of things that we have already talked about. a little bit earlier here. Very important that you take a look at that. Once all of that is done, the next thing that you'll look at, and we'll go over this in the class, is going through and figuring out what are our advanced techniques here. So for tonight, just wanted to cover, we need to network, we need to get better at that, we need to build relationships with real estate investors, we need to really sharpen our skills on creative financing, both how to do it, but also how to buy it, how to go through deals and understand what's been done. And then thirdly, sharpen our skills on bankruptcy. Tonight, I just went through 13. We'll cover 7 and everything else later on as well. And then so much more at the 2-day training. We'll get into, whoops, hang on here. Oh, let me exit out of that. We'll get into so many various techniques, advanced techniques. I don't have time, which I didn't think I would, to go through things like partials. Partials are not a new technique, once again, but what I'll tell you is a game changer on how to approach it. Most people look at partials and they focus on rates of returns and things like that. And I'll show you some things that I really typically haven't shared over the years. They're techniques that that I utilize that are more easy to understand from the consumer side. What I mean by that is there are notes that I'll save this for the live training. There's a little technique that I've shown people, which is really kind of crazy when it comes to approaching the so-called mom and pop notes. And that's another area we're definitely going to talk about. There's individual note owners that need money just in general in their lives. And a lot of them don't know that they can sell all or part of their note. And how you approach those people, it makes all the difference in the world. When I show you in class, for example, of my simple approach of saying, look, you own this house, you own this note, you're getting payments on this one. You've got 100 payments left. Your balance is $50,000. I'll tell you what, I'll buy half of your note for half of the payments. And most of you all can understand that very, very easily. And that's on purpose. And because it is simple. Mathematically, I'm making double-digit returns on a simple approach like that. I'll lay that out in class here, and it'll blow you away. Let me just, sorry guys, let me just do this real quick so I kind of open that box here. So if I've got, what did I say, $50,000 note, you know, somebody's got it written at 9% interest, and what did I say? I'll just say 120 payments on it. The monthly payments are this, $633. We'll be using calculators in class, everybody. If I were just to buy this on a yield base, that's what most people do. They go, I'll buy this note and I'll do it at 11% yield. If you bought this note, $50,000 note, 120 months, $633 at 11% yield, you're repaying $45,980. That's simple, right? Here's what I do. Because consumers don't understand the math, they want simplicity. So somebody has this note, that's the only note they ever had in their life. I'll tell you what, I'll buy half of your note for half of the payments. What do you think my yield's going to be? You can understand that. A consumer can understand that. I'm giving you $25,000 for 60 payments. Do you think my yield's higher than 11? Watch this. 25,000. That's what I'm going to buy it, and I'm buying 60 payments. My yield, there you go. You know, you want to know what's crazy? I'll put it back to the original. Not only is it easier for them to understand and for me to sell to them, if you will, I'll do a quarter. I'll give you, not 25, I'm going to do a fourth of, so I'm going to buy 25%. So 50,000 times 25%. I'll give you $12,500 for 25% of your payments, which is 30 payments. What do you think my yield is?
That's pretty awesome.
Where's my risk? Did it go up or down? My risk is lower, my return is higher. And as far as approaching somebody on them selling, you're buying, it's easy for them to, well, I'm giving you a quarter of your money for a quarter of the payments. That's all I'm doing. Or half and half. Look at that. So there'll be all kinds of pro level tips I'll be giving you guys as well. Okay, look at that. Coming up on the hour here.
So let me make a comment, circling back, and thank you, Kevin. That was very detailed, informative. Love the data and the stats and the market research you did to pull that from some of these big institutions that are putting that data out, but it's generally hard to read.
Mm-hmm.
And putting that through. So I did have a thought. So when it's a bit of, I like to just call it a waterfall of how these assets will trickle down. So when these come, and this is good just for review and to remind ourselves of like what that looks like. So because they're government backed, they're going to trickle down. Well, who are they going to trickle down to?
Mm-hmm.
Okay. They're going to trickle down to institutions that are already pre-qualified, vetted, verified, that have tens of millions of dollars, like literally ready to go, and that can onboard them. So what kind of companies are those? Well, they're private, they're equity groups, venture groups, or even larger family offices that have them. So some of them of which we used to buy from, right? Back in the day, we had like Granite and Window Rock and stuff. Now we kind of have like Mountain View, a lot of different Park Tree, some other PPR sells some stuff and has a fund going, but they're gonna acquire those assets. They're gonna do this. They're gonna start boarding them. They'll get the assignments prepared, recorded, so the assignments and allonges all match up. And they're going to pick and choose like what they want to work out and keep in-house. And simultaneously, they're going to start offering those to investors such as ourselves to allow us to bid or buy small pools or tranches of. And that's how it's going to like trickle down and work. So when Kevin's talking about networking and making sure who's out there, that's very much going to be applicable in this scenario. Some of which will be working with us. They'll either be sponsoring with us or writing with us. Revolve Capital will buy some, and they're going to basically pill off for certain groups and people to be able to purchase assets through. Just like we had in, basically from 2010 to roughly 2015, 16-ish, same scenario will kind of play out again. Mm-hmm. To work. And in addition, a lot of that inventory will go onto platforms like a Paper Stack or Loan MLS or different servicing exchanges as well, like AHP. And you'll be able to go there, bid, look at the, do your due diligence, get the loan docs, and, do the required diligence before you, look at making an offer, or, put something under contract. So that's kind of the flow of how it'll work. I think it's a good reminder of how that'll work. And so what does that mean for us? It's like, okay, we'll make sure that we got X amount of capital ready to go at any given time, or you have enough mobility to get liquidity. So if you're in the markets, that's pretty easy, meaning in stocks, or at a brokerage account, you just liquidate your assets. But if you have all your stuff tied up in physical collateral, you're going to want to start employing some of these techniques. Maybe you got to create some additional notes, note out of it, hold the second note and stuff, so you can start getting some liquidity. Ben and I are working on that with our other partner, John. Like, we want to make sure we have some liquidity, of our own, and then also some other capital partners ready to go, that we can pull the trigger on, because that's how you'll miss the opportunity, is by not being ready to go with the availability of your own funds or with some investor capital that you've raised or some joint venture partners of some sort. So I just want to remind you, now's the time to get that ready to go and be prepared for that. So anyways, I just want to go through, make sure, a reminder for everyone of what that's going to look like, how that's going to trickle down. Kevin, you had something else?
I was just, while you were talking, I was just illustrating your point in the background here. This just came out in May. I just Google searched it real quick, but 8,000 loans, Fannie Mae sale, 1.6 billion. And it just goes right back to this. They got a long way to go. There's 641,000 loans that they have. I'm not saying all of those will go through the sale, but certainly a percentage. And Fannie Mae does these about every 3 months or so. They'll do a big sale like this. So I don't know if that's the last one. I just happened to Google it, but you could Google search Fannie Mae non-performing loan sales, and that's where they trickle down. So we actually do need the big companies to come in, as you said, and buy these, and then it'll waterfall down as you were saying. So yeah.
Now, exactly in this market, we'll save this for another webinar, and this will be good to go. And we'll kind of break down what potential pricing could look like, even the discounted pricing. It's going to be different than what it was back in 2012, 13, 14, 15, when the market had crashed. Okay. We're not having those same experiences, and we're actually experiencing some inflation right now. Are we going to pick first liens up for 20, 30, 35 cents? Probably not. Okay. Does that mean that that's not a good deal? Absolutely not. Because we're in a different market climate where prices continue to increase and go up. And so, you're going to be you're going to have to take that into consideration, and also kind of factor in some volatility numbers of what if there was a decline. Do I have enough coverage, or do I have enough opportunity to still cash flow, would I be at risk to losing this portfolio? So there's going to be some different numbers analysis that we're going to do that'll be a little different than there was 8, 9, 10 years ago. What do you got there?
I'm just showing again that, so in 2021, just Fannie Mae, not Freddie Mac, not VA and FHA or Ginnie Mae, which is also doing these sales. We're just looking at one. They've had 4 sales this year.
Yeah.
To illustrate the point. 3 of them were reperforming. One was non-performing. That's another little, we'll talk about this on the thing too, but the definition of reperforming with Fannie Mae and with people in the industry, you gotta be careful of.
I love it.
Yeah.
All right. Well, is that a wrap, Ben, or bring us home?
Yeah, I would say, one thing, guys, I'm just listening to these guys, they're pros at what they do. I just happen to be kind of a lucky to be here type situation. And what I would tell you is, if you're intimidated by the idea of approaching a fund or a family office or whatever, there's 2 things that you could do here. One is to network with just individuals. Like Kevin talked about at the beginning, the people that have seller finance deals. I've done a ton of them over the last 3-4 years, and it's easy to find those people. You can scour Craigslist, Facebook, Zillow for owner financing, certain keywords, seller financing, and, start talking to those people. One, that's going to get you comfortable doing it. If you're just coming from the wholesaling world, if you're getting your started notes, you've only done traditional real estate deals, never done a note, this is the way to get your feet wet, to start looking at those kinds of deals. Because if you're a straight newbie, it could be really intimidating going to a family office. Yeah, I'd like to buy some of your notes. Well, they're going to find out if you know what you're doing pretty quickly, right? So, start sharpening your skill set with just individuals. You're going to screw up in the things that you say. So just get the practice in, get the reps in, and start talking to people on a daily basis. And there's 2 types of sellers, right? There, like Kevin said, there's the people that need to liquidate. And then there's the people, like Aaron said, the people that want to liquidate because they're setting themselves up for future deals, right? So most people, I didn't get into creating notes to be I'm going to hold notes for forever. It was a means to an end. It's an ability to, at some point pivot out of that, sell it for a gain, and just keep the ball rolling, right? So those are two different groups of people that you can find: the people that need to sell and the people that want to sell. And some people don't know they need to sell until you have a conversation with them and you can show them, hey, this is a benefit to you, and you need to get that skill set right. So if you want to come learn more about this stuff, you need to be in Orlando, September 24th and 25th. And if you, I'm going to stop sharing your screen for a second and pivot over to mine. If you go to noteworthyusa.com/events and put in the promo code Noteworthy250, it does in fact work. My man, Aaron, got it out. You will get $250 off, and we're going to have some great stuff there. So if you're not feeling like, hey, I need to know more about this, this is going to be intensive. Kevin's going to go through a whole bunch of great stuff, and it'll be practical things that you can actually go and use. So he's going to teach you how to write deals and how to look at deals and due diligence and all these other great things that are listed here. So come spend a couple days with us, and promise you won't regret it.
Case sensitive on the promo code?
All lowercase,
Thank
all lowercase, just like it reads right there.
Exactly. So this is a small event we're doing. And the reason was because, one, we wanted to make it like really in depth. When we do our big events, like you're drinking from a fire hose and it's just round after round after round, right? So this is going to be very specific, a lot of Q&A, and there's not going to be, any dumb questions. This is going to be like, hey, I need to know this stuff. What would I do in this situation? So we hope to see you there.
And for those of you listening, again, it's September 24th to the 25th, Orlando, Florida. Go to noteworthyusa.com/events. Use the promo code Noteworthy250 to get $250 off. And thanks, everyone.
Yeah. Thanks, Kev. Appreciate you, man.
Have a great night.
We'll catch you.
Bye now.